Nigeria's near-term inflation outlook appears increasingly unpredictable as the petrol shortage crisis and the rising cost of diesel have added to other challenges driving up prices of essential commodities in the country. The January Consumer Price Index released by the National Bureau of Statistics last week points to a slight moderation in the headline inflation from 15.63% in December to 15.6%. But there are fears that the direction of the inflationary trend could change significantly this month, going by the shortage of premium motor spirit, which have a ripple effect, of course, on the cost of transportation, a key driver of inflation. While fuel scarcity in the past has often revolved around increased pump price or subsidy removal, the latest scarcity biting Nigerians hard sees a new entrant, adulterated or contaminated fuel, or off the specification petroleum products. This development, notwithstanding, is already undermining economic activities as transportation costs continue to soar in different cities, leading to a worsened spike in the cost of food items, which will inadvertently affect the purchasing power and the standard of living of the masses. Let's understand the ripple effect of all of this on inflation. I have joining me live via Zoom. He is the Director, Research and Strategy at Chapel Hill, Denham, Mr. Tajuddin Ibrahim. Good afternoon, Mr. Ibrahim. Happy New Week to you.
Good afternoon. Thank you very much. Happy New Week to you too.
Yes, 15.6% from 15.63% after all of the festivities and all that we talked about in December. Finally, in January, we saw a little bit of decrease. Not too significant. Give an overview first of what you make of the figures from the NBS.
Thank you very much. I think the inflation figure for the month of January is an indication that we are not going to see much of this inflation anytime soon. And what really happened is that we had inflation coming down marginally by 3 basis points from 17.63% to 17.6%. And I think if we break it down into two components and we talk about food inflation moderated at a faster pace compared to the headline inflation. Food inflation, for instance, moderated by 24 basis points. And the second, leg of the inflation number is what we call core inflation. Core inflation is what measures how the prices of non-food items have been rising over a particular period of time. And that number was static at about 13.78%. So it did not change. So what really came down that made us to record a slight downward move in inflation was food inflation. So we have to bear in mind that it was largely speaking because food prices were going up at a relatively slower pace in the month of January compared to the month of December, and that is what we saw. I have to also add that the inflation number that was reported for the month of January, we agree that it was lower, but it was lower and it is still higher than what we were expecting. The number was still higher than what economists generally were expecting based on the consensus polled by Bloomberg. So it means we should be happy, but we still have some risk around higher inflation in the coming months because that number is not what analysts and economists were expecting. We were expecting something much lower than that inflation number in the month of January.
I will agree with you really that inflation still remains very high despite the declining pattern witnessed 8 consecutive months in the last year. Now, how would this affect monetary policies, or what monetary policies can we actually implement to rectify all of this, and how will it also affect investors and, of course, investors' confidence in our market?
Let us start from monetary policy. I think what Nigerians generally and investors should bear in mind is that inflation in Nigeria is cost pushed and not demand driven. In other climates, or let me say in other countries, largely speaking, advanced economies, you have a situation currently where inflation is a global problem, and what is driving their own inflation rate is demand. So demand is improving. But in this part of the world, I'm talking about Nigeria, what is driving our own inflation is costs. So which means that to address inflationary pressure, the government needs to work with to ensure that they put in place infrastructure that will guarantee long-term moderation of inflation, because what we currently have are policies that are broadly speaking supportive, but we do not have the right set of infrastructure that we need in this country to ensure that we can have single digit inflation or much lower inflation than we currently have. The second part is around what can the monetary policy do. There is absolutely nothing that they can do about it, because inflation that we are seeing right now is based on our structure as an economy. It is a structural problem and not a monetary problem. So we cannot solve this problem by adopting or utilizing a monetary policy tool. For instance, in other countries like in the US, there are strong considerations to increase interest rates because inflation is rising. We can understand that environment. Their own is because they are seeing higher demand. And to sort of slow down the rate of demand, they are considering increasing interest rates. In this country, if we increase interest rates, we will just be further dampening the outlook of the economy, because it will not make inflation to come down. We need to just address those fundamentals in terms of infrastructure, in terms of power supply at a relatively lower cost, in terms of water availability at a relatively lower cost, in terms of food supply at a relatively lower price for consumers generally in the country. Then we will be addressing the high inflation number that we have. It has to do with the structure and not so much of policy. The second element of it is investors. Investors will still have to be recording real negative return on their investment, in as much as you cannot generate above 17.6% on any instruments that you are investing in the current market situation. So it is negative for investors in real terms, but it is beyond their control in our view.
Great stuff there from you. Now, considering the fact that we've seen the scarcity of PMS, well, thanks to the contaminated fuel that came into the country, and this has actually affected price of transportation, and also the recent one is aviation fuel. Now we see airfare is going to like 100% hike in all of this. Electricity, like you said, rates, cost reflective tariff has always been the argument of the investors. Putting all of this together, what sort of figures are we expecting moving on? Don't you think this would also have an effect on the expected figures moving on in the year?
I absolutely agree with you that it is going to further put an upward pressure on inflation. In-house, we were previously expecting, February inflation, for instance, to be lower to around 15.55%. But with the current development in the economy, we have talked about the scarcity of PMS, and also, the electricity, prices, as well. So and also the flights, air travel cost is going to double. So what that means is that in the month of February and probably March and going forward into the middle of this year, we are probably going to see inflation go as high as like 18%. And if this trend is sustained, it is likely that inflation goes to, as bad as 18 to 19% before the end of this year. So there is an urgent need for the government to address this problem, talking about, the contaminated fuel that has been imported into the country, and, so that the effect will fizzle out, in the next, couple of months. We are going to see the effect for the month of, February inflation, no doubt about that. But beyond that level, the government should work and ensure that it doesn't go beyond February. But in terms of, aviation fuel, we are going to see that impact also on inflation, and that may take inflation above or up to like 18% in our view, because of the impact that it could have on some other goods and services in our view.
I'm scared. 18%. This time, I'm really scared, Mr. Tajin. I must tell you. But let's wrap up this interview with another two-in-one question. First is, it's a pre-election year and we expect a lot of spending. And many believe that this could also maybe give liquidity boost to the economy. I don't know. Do you share the sentiment? That's on one side. If the U.S. also happens to increase rates, what effects do you think it will have on Nigerian economy? Some say FPI might decline. And of course, debt servicing costs might be on the high side.
So the first one, which is around the, what could happen in terms of liquidity flow, because it is a pre-election year, I think we should just be honest that, there will be some level of, liquidity, pumped into the system because of, election processes, that we should not, argue about. But what we would expect is that the CBN, is proactive in ensuring that any liquidity that flows into the economy that could have impact on key elements of macroeconomic indicators is mopped out of the financial system as quickly as possible. That is our expectation. So we should expect the CBN to be proactive on that front. The second one, which is around I seem to have forgotten the second question.
No, the second one is around interest rates in the U.S.
Interest rate in the U.S., I said it earlier.
Yeah.
Raising interest rate in the U.S. is a normal thing for them because they are seeing the impact of demand, lifting inflation to a 40-year high. So they really need to raise interest rates. But in here in Nigeria, we do not have as many foreign investors investments as we used to have it like 5-7 years ago. So there is little or no need for investors to panic. We may not really see much of that impact on our own economy. And my belief also is that the CBN will watch how that impacts our economy. The broad expectation is that it will not be material, and on the back of that, we may not necessarily consider tightening monetary policy too soon. We may tighten, but it will not be, too soon or as soon as the U.S., for instance, is looking to tighten it up, in our opinion.
Finally, liquidity challenges and the FX market is also contributing to our inflation rates. Do you agree to that?
I absolutely agree. Let me give you an example. Inflation came out. Food inflation, I said earlier, came down. I said core inflation was flat. It did not come down. It did not go up. But what went up was imported food inflation. That number went up in January versus the level in December. And what that means is that it is reflecting the impact of currency weakness, Naira weakness in this case. And if Naira weaknesses continues in this coming months, we'll probably continue to see imported food inflation rising, probably steadily.
Well, it's a good way to leave it. Brilliant conversation there. I've been speaking to the Director of Research and Strategy, Chapel Hill, Denham, Mr. Tajuddin Ibrahim. Thank you so much for spending your Monday afternoon with us. We appreciate this.
Thank you.